Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. Markets are at a 1 month low. They have corrected about 3.5% in the month of June only, in the month of July only, after rising substantially over the last 4 months to a 9-month high. At this stage, the Q1 earnings that are coming in provide little hope to long-term holders of equity, and there is quite a bit of pain in the market, mainly because of how IT stocks have performed in their first quarter earnings. Joining us now on the show is Mr. Abhay Agarwal. He is the founder at Piper Serica PMS, a very well-known market expert. He has been in the market for the last 3 decades or so, has seen all the phases that we can think of: volatility, bull phase, bear phase, sideways phase, angry phase, happy phase, and made a lot of money for his investors. At the moment, Abhayji is managing about 1200 crore rupees in several strategies, primarily being the leadership portfolio strategy. A very warm welcome to you, Abhayji, and as always, it's such a pleasure hosting you. How do you think sentiment is placed in Dalal Street at this moment, when there is this absolute lack of a trade deal between India and the US, and of course Q1 has been nothing to talk about?
Good afternoon, Shailji. First of all, really wonderful to be talking to you again. I always look forward to coming to you and chatting with you. So first of all, I think the markets right now, if you look at the broad market index level, I think there is nothing that is exciting the markets because the earnings, as you said, have been a mixed bag from large caps, especially. The commentary has been also conservative. So I think I will not be surprised to see the broad market, the Nifty index, consolidate in a 5% kind of range, say from 24,500 to 25,500 over the next 2-3 months. The reason being that there are, no big triggers other than probably an interest rate cut, a further fall in inflation maybe. But the what I think is going to be interesting for investors in the market will be stock specific moves, because what I can see clearly is that the companies that are outperforming the expectations even slightly are getting rewarded by the market. So I think it will be for next couple of months a more of a stock specific market, where companies that miss earnings give poor commentary, they will see pressure on the stock prices, whereas companies that outperform and have bullish commentary will get rewarded by the markets. So I think investors will have to make peace with that this will be a stock specific market for next 2-3 months.
Abhayji, when I look to your portfolio, the details of which will be there right in front of our screen, these are quality stock picks which eschew popularity. Your top 5 stocks in the leadership portfolio strategy are Shraddha Cropchem, Fusion
Sharda Cropchem.
Finance. Yes, Sharda Cropchem, Fusion Finance, from the PLI space, Amber Enterprises, in the banking sector, private space you have Bandhan, and of course Dhanuka Agritech has been a long-term favorite of yours. What are you looking for when you look to put in client funds in a small cap or a mid cap space? In broader terminology, what are the 3 or 5 things that you are looking at in your filters which these stocks have passed?
So Shailji, one thing that we look at very closely, and which is, I can say, our first and biggest filter, is clear growth trajectory over the next 3 to 5 years. So we do not start by looking at valuations. Valuations come later for us. Of course, they are a big part of our investment decision making. But what we want to see is how and why are these companies going to get on a rapid growth path of 25-30% annual increase in top line and earnings, margin expansion, everything that is a dream for an investor for next 3 to 5 years. And that is where most of our research is focused. And there we find, Shalji, companies which have either been going sideways for last 3 4 years because they were making a base for growth, and now that growth is coming in. So we like to catch them at just that point where they have underperformed the market, but all the hard work is now going to come into play. And the second category is where the companies have very strong tailwinds, like one of the companies that you mentioned, Amber. And then we also have similar companies like Sirma SGS and Keynes in our portfolio, the whole EMS basket, which has very strong tailwinds in its favor, anyways. So our strategy is basically growth investing, and that's what we like to see. Sometimes we find growth companies where they have underperformed, now ready for growth. Sometimes we find companies that are primed for growth in the core business itself and that have grown in the past also and will continue to grow. So I think that is our prime filter. And then, of course, there are other things that come into play. That is the growth generating higher free cash flow, because we don't want to look at companies that are using balance sheet to support growth. What we want to see is that the growth is leading to higher and higher free cash flow. And that free cash flow is being generated and invested back into the business to generate an even high ROI. So how is the ROI moving, ROE moving, and ROCE moving along with the company's growth? Those are the important things. So I think these are the filters once we are satisfied. And of course, founders and management reputation, how are they seen in the market by different stakeholders? That is the another big filter for us.
In your letter to unit holders, Abhayji, you start with the defense and aerospace as a 5-year strategic outlook, where you may place fresh money or you have existing stocks for your unit holders. How do you the last time we met, between that and now, we've had two major global events. One is the 90-hour war between India and Pakistan, and of course the US, Iran and Israel conflict. No matter how you see it, it's continuing. Against this backdrop of rising global tensions everywhere, how is your own portfolio at Piper Serica placed to benefit from this uptick that we've seen in defense?
Yeah, I think all the, first of all, I would like to say that all the wars, are unfortunate events, and but at the same time, it is a reality that the real world that we live in. So none of us want to engage in war, but at the same time, defending countries' borders
Yes.
from
Yes.
rogue elements is a very important thing, and that's the government's duty. And as capital allocators, if we can support it, then definitely we will support it. I would say that, Shalji, if you have seen also that all these wars in the recent past have been driven by technology. I mean, you haven't had traditional warfare where troops tried to cross the border and engage in hand-to-hand combat, or heavy artillery tank movement was called, or the navy was deployed. It has largely been driven by technology, and the technology is advanced to a level that through drones, through satellite based imagery, you can pinpoint exactly what the enemy is doing. You don't need to build very deep intelligence networks. So with that perspective, that the nature of warfare is changing, our portfolio companies that we have are supporting the government's focus on generating, higher, better and better surveillance systems, radar systems. So companies like, again, these are not buy recommendations, but these are in our portfolio. So I can say that, these are part of the model portfolio companies. So Data Patterns, Sirma, SGS, Keynes, which is building India's first semiconductor OSAT plant, packaging plant, which will be very important for the defense forces to buy indigenous chips, rather than depending on imported chips. So these are the kind of companies that we are backing, that they have very strong technology skills of electronics, semiconductors, radar systems, drone, avionics, and we are backing them to work with the defense forces and with satellite, companies, to provide them the products and technology that they need.
Okay. In the leadership strategy portfolio, which are the defense stocks that you mentioned you have? SGS, Sirma, I got it. What were
Yeah,
the two?
Sirma SGS, there is Keynes Technology,
Acha,
uh,
okay.
and then there is Amber itself, Dixon. I think in some way or the other, they are all impacting the defense space.
Fair point. So it's primarily the PLI space that is also quasi defense for you.
Of
Fair
course.
point. Okay, fair point. So that's how it is. Now, what are the sectors, Abhayji, that you are avoiding? Is there a case for even overvaluation at this point of time in the market, in your own portfolio? I was unable to see a pharma stock in the top 10, but I did see two agrichem spaces. There is Sharda, and there is, of course, your eternal favorite Dhanuka.
The pharma names are also there, but the allocation to them is about 12%. So they don't show up in the. So we have three pharma stocks. One of them is Dr. Reddy's, which we have for quite a while. Then there is Divi's, which is one of our favorite companies. I think that is a prime example of how through astute capital allocation and building a business for long term rather than taking short term decision, you can drive value and surprise analysts and surprise the markets. So Divi's is something that we believe is going to be a long-term winner for all shareholders because they're building a very strong global CDMO business, which is already found a lot of takers. So this is what, and then we have another domestic CDMO player called Windlass, and Windlass is a company that is a bet on the focus on better manufacturing of pharmaceuticals for the Indian customers. So this is still contract manufacturing, but more for Indian pharma industry, domestic manufacturing than external. So I think these are the companies that we have in our portfolio that are focused on pharma. Pharma continues to be our favorite. We are looking at more opportunities. To answer your question, which sectors we are avoiding? We have been underweight IT services for 2 years. We do not have any IT services company, and I think because of lack of innovation and sticking to old time and material model, margins and growth both are under pressure. And I think the stock prices recently are also reflecting that. I don't expect anything to change there for another year or so. So we are going to be out of IT for at least one more year. I don't, with the current commentary, with the current focus on traditional models, I don't expect any upside in IT services. And the second sector that we are underweight on because of high valuations of traditional players is FMCG. So I think it is probably better for investors to play the FMCG and domestic consumption story through some of the internet consumer names now, because they are growing faster and they are already becoming profitable, and the profits will grow dramatically over the traditional players. So I still struggle to pay 60 times, 50 times P multiple for low growth FMCG names, which have been historical favorites of mutual funds. I would much rather, pay for consumer internet companies that are now growing much faster, have very strong unit economics after 5, 6 years, and gaining market share. So we are very underweight on FMCG. At the same time, we are looking to add some names in the consumer internet side.
I think, Abhayji, there would be no better person than you to comment on a tectonic event that's happened today. Zomato's market cap
Yeah.
exceeded that of Titan. And this falls exactly in the same segment as you mentioned: e-commerce, quick commerce, rising unit growth, and of course rising acceptance. Eternal, which is Zomato, is
Yeah.
the top traded counter today, 11% higher, record high. 7,000 crores has already been traded, and we are still at 230. So how do you see uh, you know Eternal against the backdrop of your own thesis that this is a growing space with growing market share, and of course a large blue sky or blue ocean market yet to tap in? Uh, do your do your portfolios represent something in the uh, you know e-commerce space?
So I think what has happened, Shelji, is that you were seeing some of these companies' prices come back, and again, no buying recommendations, but just giving an example of some of the names in that, like Policy Bazaar or different spaces, Paytm, Zomato. You mentioned Swiggy. There are about 8, 10, 12 listed companies in that space. More will come and list. But I think what is happening in this space is that this is a winner take all market, and these are the companies that have survived the valley of death. There are a lot of companies that started along with them. So these are the leaders, and these are monopolies now, or duopolies at best. There are one or two companies in the very fast growing space, and this space is growing at a so fast that unit economics are now slowly falling into place, which was a problem. But now these companies have demonstrated that if you can grow, you can generate profitability. Because for a lot of long time, there was a worry that is this growth coming from throwing money and burning money? So these businesses will never be profitable and they will flame out. But now I think there is investor confidence that as these businesses grow, they will actually become more profitable and not less profitable. So, in that backdrop, I think it's not only Eternal or Swiggy. I think there are a bunch of listed internet companies that listed 5 years ago, 6 years ago, that have finally found the product market fit, the business model, the management structures, the distribution systems, the
Correct.
control over various metrics. So, one of the companies that we have added to our model portfolio recently is CarTrade.
Yes.
And I think it is a company that represents the entire auto industry because they are the largest lead generators for all OEMs in the country. So you don't have to back one OEM, through CarTrade, you're getting to back the entire auto industry, entire auto sales. Secondly,
Yes.
they have acquired OLX, which is India's largest digital, classified company, and they'll start monetizing that also soon. So I think companies like these, which are trading still at a very sensible valuation, will outperform the traditional players is what we are betting on. And I think the market is also realizing uh, that to make money in India, you need to back growth companies. You can't look at just large cap, steady earners.
Okay. You don't mind the 900 PE that Zomato quotes at?
No, so Zomato is not in our portfolio,
Okay.
model portfolio, because we are not, of course, that is where the valuation screen also comes. And I'm sure the investors who are buying it probably not making a mistake. I don't want to be judgmental about that, but it's just that everybody has their own framework. It doesn't fit into our framework. But you look at CarTrade, for example, CarTrade is trading at 35 times forward P multiple
Yeah.
with, almost 1,000 crores of cash on the books, profitable. So that is something that still fits into our investment criteria.
Okay. CarTrade, of course, has done phenomenal in the last 8 10 months or so. I'll request the PCR to kindly fire the longer term chart. It had a miserable listing and then an even more miserable 6 months after the listing. But it seems to have made a massive turnaround. More value to be had beyond 1900 Abhayji in CarTrade?
Yeah, see, for us, these are long-term bets, Shailji. So when we add something, as I said, this is a classic example of buying it at the right time because you see companies underperform, struggling to get the business model right. And then they get the model right when the investors have given up, and that is a great entry point. So I think that is where we benefited in this case also. And for us, it's a 5
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily Calls, a show that answers all your stock-related queries. In case you're here for the first time, well, you can WhatsApp us your questions on the WhatsApp number flashing on your screens. Don't forget to mention your name, location and your contact details so that we can give you